Good morning. How does it sound? I need to test the sound. Testing. Okay, looks like it sounds pretty good. I had pinched the cable. I dropped it under something and it it's bent now. And I hope. I pinched the cable. Oops, there's your feedback. Yeah, anyway, it should work fine. Very good, very good. So I really apologize about last week. I had to make that appointment, and anyways, then there was a meeting, and finally I made the video. I think there were only a couple of people in the in the class, but that's fine. I hope you got to see it. What I want to do today is just go touch on some of the things I said, go deeper a bit in the last section, and then answer some questions. There was one handout 3.7 from the last module that I did not cover. I didn't give you the solutions either. And then I'll answer any questions that you have. So the test, I will administer the test starting tonight. Now, I wasn't originally planned that way, but a few students contacted me and they want to have they need to have the test early. My prontuario outlines that in the usual circumstance, I will, for justifiable reasons, I would move the weight of that test to the last or the final test, the final exam. For unreasonable requests, I will just give the student 0. But in this case, I decided that I understand that things are so uncertain right now and it's hard to plan. So what I'm going to do is give you the test at 6 p.m. today, and you have until 3 p.m. to hand it in. Again, it should only take you an hour and a half. Now, I know students are taking a lot of time to prepare their tests. I actually regraded all your tests, and I will send them back to you. I guess I can send them to you today. I regraded all your tests. Some people will be shocked that I took off a lot of marks, but you'll see why. I made notes about why I deducted so many marks, and keeping in mind that I will use a regrading scheme if that helps you. So I'll put more weight. I'll put the higher weight towards the final if that helps. So these tests are meant to be easy. That should have been an easy test. So you should have had more than 25 out of 30 on that test. Just some mistakes here and there. Most students had about 27 out of 30. And then some just didn't follow the instructions. Some tests look very familiar, very similar to other tests. So I warn you not to copy each other, because if I can see clearly that students are copying, and that's obvious when several students make the same error. Okay, I can see it pretty clearly, and on this test, I will be looking out for that. And if you are a person who's using somebody else's test answers, then everyone, including the person who is, I won't be able to tell the difference, or maybe I can, because usually the person who works the problem out has neater writing or looks more logical and makes less mistakes than the others copying. But I can tell what's going on. So not to accuse any one person right now, but if you think you want to help the other students, don't, because I'm going to take marks off for everyone involved in that. So do your own work. This is going to be an easy test. I say easy. It should be doable. All right, it's going to be questions that are similar to the ones you've seen. And just like the last test, even though I didn't teach interest rate conversions early on with the material, I did have you did have to do an interest rate conversion here or there. If you didn't do it, if you didn't understand, I didn't take off a lot of marks. You only lost a half a mark. Or on the last question, most students lost 2.5 marks, but out of 5, but they got most of the other questions 100% correct. So this is how I'm going to proceed. I'm going to give you the tests at 6 p.m. You should give them back to me by 3. You should work individually. If you have any questions, ask me. And don't copy each other's work, because I can tell. Okay? All right, so I hope most of you got to see the last video. How's the view look? Last week it was kind of blurry. I don't know if that was my signal that was making the view blurry. So what we have to do is then look at this material. I'm gonna kind of fill in the gaps. I didn't touch all the pages. So what we did here was talk about creating the cash flows for a project before we analyze it. Okay, so the Module 3 material was all about different techniques for valuing cash flows or projects. And then this one was about actually determining what those cash flows, estimating what those cash flows would be. And lots of assumptions go into setting up these cases that I've given you. I gave you a bunch of cases, and it is overwhelming at first because you have to read a lot. But once you do a few of them, you see the pattern. Now, you get to use all your materials for the test, so just follow along with what you've seen there, and I'll give you, like I said, something fairly basic. So these tests that I give, this first one that I gave you, the second one that's coming today, and then the third one will be basic, but the final test will cover everything, and you're going to be expected to know all of this material, okay? Right. Let's see. So what I talked about in the beginning is pointing out that we're doing a financial analysis, right? So we care about cash flows, which is different than accounting income, and I get into that because in accounting particularly, you're allowed to depreciate capital, depreciate purchases that are, manufacturing equipment, buildings, and account for the wear and tear of those items as a cost, reducing your taxable income. And in accounting, that gets recorded and reduces your profit, increases your net income. But in terms of cash flows, depreciation is not a cash flow. How that affects your cash flow analysis is that depreciation results in reducing your taxable income and eventually tax savings. So I spend relatively a lot of time explaining the effect of depreciation and then how we include those tax savings in our cash flows projections. Okay, so I skipped over this and I said I would review it today, so let's talk about that. So we did do this we had this discussion about, let me make this bigger. Oh, sorry, let me go back a bit. We talked about this. So I talked about this. Does anyone have any questions about incremental cash flows? Yeah, you see, I have 2 on a slide. I usually use this is the version of the notes that I gave you, 2 on a page. Okay, any questions about this? No? So this is just identifying incremental cash flows. All right, so then let's talk about what is the right discount rate to use. And we did learn about this earlier. I explained this to you back in the first module, that if you have nominal cash flows, use the nominal rate. If you have real cash flows, you use the real rate. Okay, and then I talked about how you convert to real rate, or nominal rate from the real rate, given the inflation rate. And so there's this relationship, the Fisher relation, to get you from one to another. And these were the takeaways. And to point out that what we want to use in our analysis is the appropriate discount rate. And we're going to not only consider nominal cash flows with the nominal rate and the real cash flows at the real rate, but we're also going to talk about, and that's going to be in the next unit, we're going to talk about accounting for risk, adjusting for the risk of those future cash flows. And adjusting our rate of return so that the higher risk projects are discounted at a higher rate of return. All right, so that's going to be next, but anyway, I made the point here. What is this whole business about discount rate? I'm going to spend much more time on this. Of course, the whole next unit will be about this discussion. All right, so then I give it an exercise. Oh, did I cover the other one? Sorry. All right, so here is this discussion here in terms of the inflation in the housing market. So I'll just focus on the housing market. Remember, there's many rates in many different sectors. We're going to focus on the housing market for a moment as an example and talk about having $2 million. In this case, the financial markets, we're going to say the rate of interest available in the financial markets is 4%, let's say, with no inflation. But in the housing market, where this $2 million is going to be spent, okay, so this endowment is to be used, this amount is to be used for housing, okay, for a home. And the intention is targeted for the housing market, and currently there is a nominal interest rate of 4% in the housing market. However, so we'll see a 4% rate of return is anticipated in the housing market, but there's inflation. There's inflation, so prices are rising. So if a person is intent on purchasing in the housing market, they have to be aware of this inflation and realize that $2 million right now is going to buy you a house right now, but it won't buy you a house in a year's time because there's inflation. So the question is, should you buy in Beverly Hills? Okay, so a house in Beverly Hills is $2 million. If you don't buy, your money grows to this amount. If you do buy, your house will be worth this amount. And then presumably if you wanted to move into another house, you could afford a house around this amount with the same money, or something similar, maybe less. If you go scale down, smaller house, or you could spend more and scale up. But the point is, the same house next year will be worth this much. So if you said you were shopping around, a person was shopping around for a home right now in the presence of inflation, maybe they didn't find the one that they wanted, but to preserve the purchasing power of their money, it's advisable to just buy a house as a store of value so that they can retain the value of the $2 million, and hopefully they can resell if they don't like it so much, but at least they'll be in a $2 million house retaining the purchasing power. Okay, so the real value of money has depreciated. If you're interested in purchasing home, you need to be aware of that. Any questions? So just some calculations, looking again, so that was an example, looking again at the formulas I gave you. If you wanted to calculate the real rate of the inflation, given the real and nominal that were just given the nominal rate of 4% and the inflation rate that was introduced, it captures here, the real rate captures the erosion factor. You know, what happens because of inflation, in the presence of inflation, you lose value in your cash holdings. So then I just make some calculations here, looking, we're playing with the formula. Just to demonstrate that, right, with $2,000, is the real value, what is that in nominal terms? It's going to be 2. So this is just the same calculation that I made, but I've just attached it to the formula, the notation that I showed you. Yeah, I mean, if you're really in the market for a home, then you should buy a home because the inflation is so high. And that could happen. There's just excess demand pushing up the prices. This is actually, people are telling me that this is what's happening in the housing market here in Puerto Rico right now. Because of low interest rates, people are pushing up the value of the homes. Now, this inflation might not be happening in other markets, but in the housing sector it could happen. So right now houses are worth a lot. So they should have bought last year because now it's too expensive. All right, so now right now we'd be in like year one relative to last year. So that's good for people who are selling, but if they don't have somewhere to go, they're going to need just as much money to buy a new home, just as much as they sold it, unless they're scaling down, unless maybe they're retiring or they already retired and they want to sell their home, and now is a good time because the prices are high, and then they can go into a condo for much less or move in with their kids who have space for them, something like that. Anyway, just letting you know. Exactly, Paolo, just leaving the money in the bank and not buying and saying, well, I want to find the right house. I don't know. I'm not sure. Yeah, you would be losing in the housing market. Well, I mean, not necessarily. Like, let's say somebody went and bought this house and they really didn't like it, and then they couldn't sell it the year later. That's going to be problematic too. So, I mean, there's many things to weigh out. But these are the things you have to take into consideration. Okay, so what did I say so far? Oh, I said everything. All right, so you can find the real rate, which reflects the effect on purchasing power, and you can make this calculation using the notation, just as an exercise, as an example. So this is, again, another using the same numbers. Now, how is this going to play out with what I told you before? You should be discounting the real dollars with the real rate or the nominal dollars with the nominal rate. In terms of nominal dollars, buying the house today, so this is just a normal regular situation, $2 million, buying the home now, next period it's worth $2,100,000. You might sell, you might not sell it, but this is the market value. That demonstrates that option is valued at almost $20,000, $19,000. So that reflects the value added, right, of purchasing now. So it's a way of looking at it in a different way. So over here, I looked at the amounts just as we did when I introduced this earlier, saying you can compare these values and see that it's better to just buy the home because of the inflation eroding the value of your savings. In this situation, I'm using the net present value approach, bringing the dollars back to time zero. That reflects the profitability of making the purchase now. Now, again, I should be able to make the same calculation using the real amounts and real dollars. Now, you're looking at this. What you should see is this is $2,000 in both, right? These are the real dollar amounts. And I explained to you when we talk about real dollars, what we're saying is we're talking about the purchasing power. So relative to a point in time. So today, or now, $2 million buys me a house. In real dollars, how much is going to buy me a house next period? Well, $2 million, 2 million real dollars. It's synonymous. So whatever, it's all based on this period here. So in this period, $2 million buys me a house. So I want to be able to buy a house next period. That's also $2 million in real terms. Okay, so this is real. So you look back at the notes to see what we did there. But to actually get the same result, I have to use the real rate. So discounting with the real rate, it demonstrates that. So it has to be a negative interest rate. All right, so you can stare at that, practice that. So it's saying the same, it's just another way of arriving at the same conclusion, that you should invest or buy the house. Okay, so this is all right. So let me pull this down. All right, we did this. Okay, so that's it. That's all I'm going to say about that. Right, so that was just an example. You've already seen those calculations. It's just an example. So last class, I made this. We began before after we read the case. I went through which cash flows are incremental, and those would be going into our projected cash flows. And then really I started with talking about net operating cash flows. So this is all that goes into net operating cash flows. You need to combine the cash flows so that you have revenues, expenses, and taxes accounted for in each year. And then I did some manipulations here, because what I want to get out of here is I want to separate or tease these apart so that you can see the impact of depreciation. It's just it has to do with how I'm going to quantify the cash flows, because what I go on to do later is talk about evaluating the case in 3 steps. And the 3 are income, investment, and tax shields, or the effect of tax savings due to depreciation. So I start here with unraveling this expression. I tell you that taxes is just taxes on taxable income. What's taxable income? Revenues minus expenses minus any depreciation. And then I take time later to calculate what D is. So I manipulate this by separating here, distributing. Oh, sorry. No, this is from here. So I just rewrite this. This is that here. And then I rewrite taxes as this expression. So I just copy this down here. And now I regroup. I take a moment and I distribute this so you can see what the in-between step. And then pull these together. So factoring this out and then adding this term here. Okay, so let me put this higher. All right, so hopefully you saw that. If not, go through the steps yourself and you'll see it. So what I'm able to do is rewrite net revenues after taxes as net operating cash flows, net revenues after taxes, plus this the tax shield due to depreciation. And it's all it is the amount that you can depreciate or claim as wear and tear on capital, on your machinery, your building, electronics. In this case, or in our case that we covered, was airplanes, and then just multiply by the tax rate. And this is added to your earnings before depreciation and taxes. So I've completely removed depreciation and added it back here. So this is because depreciation itself is not a cash flow, right? So that's how I convert usual income statement into cash flows. Okay, so just to point out what exactly just happened, I have a floating term. So in the income statement, this is how revenues expense. This is just an example. These numbers come from, they're just made up numbers, but to be consistent, I'm going to refer to the same set of numbers in each scenario. So in the income statement, you would see revenues, expenses, earnings before depreciation and taxes, and then depreciation would appear. So this is just a number, just put it here. And like I discussed how we get D later, but so this is 10. And then you have in earnings before depreciation and taxes, to which you apply the taxes, and here's your net income. If you're doing a cash flow analysis, depreciation is not a cash flow. So this would be without depreciation, but that's not correct because you would be ignoring the impact of depreciation on reducing taxable income over here. So everything's the same here and here. We don't include depreciation as a cash flow. This would be earnings before depreciation and taxes. However, this number should be the same because to calculate taxes, you have to make the same calculation on the side, right? So you still have to use the earnings before taxes with depreciation. So this value still is being used to make that calculation of the taxes. Okay, so that's 8. So if you compare it to ignoring depreciation completely, you see you're paying less taxes. That needs to go in here, and it looks like your cash flows look higher than income. So these are not the same. So to replicate this to get the same answer using the formula that we just derived, net revenues after tax plus the tax shield, we can do that to get 22. So you see the numbers here. This is earnings before depreciation and taxes was 30 here. After tax, plus add back the cash flows, and you get the 22. So this formula works, is basically what I'm showing you. So the tax shield is equivalent to a cash inflow. It's tax savings. It's a positive cash flow, and so it should be included in any cash flow based analysis. So this formula works essentially, okay? And just to make a point, because like this 10 comes out of nowhere, it's just, I had to put something here. But to calculate D, we use the IRS rules for depreciating assets for tax purposes as summarized in the makers tables that I shared a sample with you. Okay. Okay, so then I already went through the case. I identified what all the incremental cash flows were. I separated into 3 parts, starting with income. I put everything in a table. And I explained last class, students really like tables, I guess, because they learn accounting first, so you like to stick with the tables. And that's okay, but there's advantages to be had if the cash flows have a pattern. You can actually use annuity formulas to make these estimates, and that doesn't have to be in a table form. So you'll see my answers ultimately won't be in tables. I'm going to use the formulas to get the answers. If you want to use the tables, that's up to you. Now, because I give you so much time to do the test, you could do both, right? You can take time doing the table if you want. You can do the formulas. You should be able to get the same answer. And then here, so I show you how to put those cash flows together in the page earlier, and then for the first part, for income, you calculate about $24 million in income in net present value terms. However, there are other components to this analysis, right? You have the investment piece. And then so the investment piece will be a negative because that's going to reflect the purchases, and then your net working capital investment, the money, the operating amounts that you have set aside for the project. So that'll be the negative piece, and then the tax shields would be positive because those reflect, the tax savings. So then I went through, so I'm just reviewing, hopefully you saw the videos, how you calculate each piece. I'm going to make this small just so I can, so I showed you how to actually get the D. So we calculate the D for each year, right? Because net operating cash flow was just for 1 year. This is helping you get the D for every year. And then from there, you calculate the book value, what remains on the after depreciating the asset. Okay, so I'm kind of just rambling now because I'm not sure where you need me to go, but I put everything together. I described how to do the last step, and I put everything into the table. So the first, what did I do here? Okay, so this was the second part, was to get the investment. This was the purchase of the plane and initial investment in the net working capital. Net working capital requirements increase initially, and then we close out the project and release those funds back to the firm. So these appear as a negative, but then as a positive, right? And I describe why. And this then at the end, in the 4th year, we sell the planes and we deal with the tax treatment of the planes. So these are the investment cash flows, total investment cash flows. Discounting them, they're worth negative $32 million. So that's going to offset our revenues calculated in the first part. In the third part, we take the tax shields computed from the table. So these are the amounts we're allowed to claim for depreciation. So 2 million in the first year, almost 4 million in the second, almost 3 million in the third, and 2 million. And that's enough in discounted terms to offset the investment costs. So it's obviously very important. So our project in the end, when we put all these pieces together, so the 3 pieces, I mean, it's a lot of pieces, but eventually it's just 3 parts. The project has a positive NPV and we should invest in it. So we accept the Bahamas project. Okay, any questions? On this slide, what I do here is show you, for those people who really love the tables, putting everything into the tables together. One large table you can divide by income, investment, and tax shields and get the total project cash flows. So this looks more like, forget about everything I did, this looks more like what we were doing back in Module 3. I give you a set of cash flows and you can use the NPV to calculate the NPV formula to see the profitability of the project. You also could have used the IRR. You could do that with these cash flows now that you have them. But if I don't do it this way, with all of them in one sheet, I won't be able to get these 3 cash flows. The 5 cash flows. So what you guys can calculate the IRR of this project. How about that? So unless I ask for it, you don't have to do it this way. You don't have to put all the information on one sheet and get the total project cash flows. If you like, you can do it that way. So what's the IRR of the project? Anyone can confirm that? Paula got it right? 10.2562? Okay, yes, 10.26, right? Okay, so you got 10.26. And how do we conclude? The firm used a discount rate of 10%. So they're saying that if they weren't investing in the Bahamas line, they would use that allocation of funds to, they expect a return of 10% in any other alternative investments that they would have pursued. All right, so they have the option of going somewhere and earning 10%. So this project actually, according to the internal rate of return, is slightly better than that. So this meets the criteria by the IRR. You should invest. Okay. Now, if you were to do this analysis, with the real cash flows, you'd have to convert the dollars, the amounts here, to real dollars. And I do that here. So that's done because you want, when you look at future cash flows in real dollars, I explained this before, people would know how to interpret these amounts. They'll say, oh, well, 3,400 and 385, given the assumptions are true that there's an inflation that's consistent at 4% for each year for the next 4 years, if that's true, then when I'm looking at these numbers, it's capturing or it's reflecting what I would be able to buy in those years. So, $6,000 today would buy me a used car, a nice used car. So that reflects that to me. So everything would be relative to base year and capturing the purchasing power of my money. It's not so different to those up here, but in millions of dollars, it can make a difference, right? Because these are in thousands, which are really millions. So here, this is this is actually 6 million, not 6,000 to buy a car. But okay, so I would discount those with the real rate. I mentioned that we do this calculation with the income, with the investment cash flows, but not the tax shields. Tax shields are seen as a nominal set of cash flows. You can't convert those theoretically to real. So you would use the nominal rate for them. So this number stays the same, but these were converted to real cash flows. All the numbers should be the same as you had before. However, all should be the same because of the rule: real cash flows with the real rate, nominal cash flows with the nominal rate. That's the point here. So you can just practice making calculations. So that's it. That's all I really wanted to talk about here. If that helps in a review, what we want to do, these are all the tests here. Let's do an exercise in capital budgeting, and then are there any particular ones that I gave you that you have questions about, or can I pick one? Okay, I know I gave you one without an answer, right? I gave you one without an answer. So let's do the one without an answer, and then we'll go backwards. Okay, so what about 4.9? 4.9. I gave you that one, didn't I? Yeah, we'll go backwards after. Let me just do the capital budgeting, and then we'll go back to 3.7, Paula. Okay? Do you have the answer for 4.9? I don't remember what I gave you. I have to look. I have to check my email. Okay, I'm just checking. Yeah, I didn't give it to you. Okay, let's do 4.9. Okay, so let's look at 4.9 together. Oh, I have to put it in here. So let's do 4.9 completely together. And then we'll go back. Anyone do it already? I know it seems like I gave you a lot, but really, you're going to be okay. You have everything you need, and the tests will help you crystallize your understanding. So I don't think any one is more difficult than the other. You just have do them all. They're all about the same difficulty. Some of the problems, some of the cases eliminate some of the components. You don't have to do all of it. So it seems easier that way, but they're all the same level of challenge. Okay, so I'll let you read the case. I'll give you 2 minutes. I should give you 5 minutes. Some people haven't read it.
How's it going? Any questions?
All right, let's see. Your company, NTL, has been considering introducing computer hardware to its ongoing operations. NTL can acquire a network computer system which would cost $140,000 and require ongoing maintenance costs. All right, so what do we have? We have so what do we call this? How should we refer to that amount? And in which category, 1, 2, or 3, does it fall? Is it income, investment, or tax shields? Oh, I have that. I don't know why that thing appears. Don't even see it on my screen, but I see it on YouTube. Okay, I get it. Right. So that's capital spending. And that's our initial investment. Which is the second part, right? Goes under investment. Okay. And require ongoing maintenance costs. What do we call this and where does it go? And I am not even mentioning incremental. So far everything's incremental. Incremental. This is incremental. What do we call this and where does it go? 1, 2, or 3? Come on. Okay, so that again requires ongoing maintenance costs. Costs. Where does it go? It's not investment. It's costs. So this is going to be expense. So it goes in 1, right? As income, it's part of the expenses. This would require $15,000 in inventory supplies each year. These inventory supplies would be recovered at the end of the project. What do we call that? $15,000. And where does it go? No one? Are you guys taking a break? Are you there? Nobody? Inventory supplies. Inventory is net working capital asset. So this is net working capital asset. This is a short-term asset, right? And this goes into the analysis for investment because we have to spend money to get the inventory for the project. So this goes into 2. What else? In the expected, it is expected that the the computer hardware components. Okay, thanks for letting me know you're here. Okay, where was I? Okay, it is expected that the computer hardware components could be sold for $20,000 in 5 years. Okay, 5 years. This project, do I mention it's 5 years? So that's 5 years. Okay, so it's a 5-year project. Let me underline that. The expected life of the system. Okay, so this is a 5-year project. That's really important. And this amount, what is this amount called? And where does it go? Okay, close, not income. So it can be sold. This is called salvage. And the salvage goes into investment because we get our money back. So this goes into number 2. Okay, so we have something about expenses. We have something about assets. Okay, so we have something with income, something with investment, but we have nothing with the tax shield. So where's the tax shield in all of this? How are we going to calculate tax shields? I'm not done with this yet, so don't worry that if you didn't get it, I'm going to repeat this. So which component, which element goes into the tax shields? Where do I get that from? Are there tax shields? Well, we bought this equipment, this computer system, and then we are going to expense, right, the wear and tear on the system. So this is where we're going to be able to look at the depreciation. So this is also for the capital spending. That also goes in 3. We need that for 3. All right, so that's it, but there's nothing else here. There's nothing about income. There's nothing about income. It's just all that information. So, well, in this sort of a problem, what we're going to do is we're going to compare 2 alternative systems, and we're going to assume Sorry, I'm thinking right now. It's slowing me down. Okay. We're going to compare two systems, and we're going to assume they make the same income. So we don't need, in the comparison, and this is, I don't know if I have another exercise where I compare, you have to make a choice between two, which is fine. I mean, we can do that. It's just, I can leave some things out. If I assume that the income that we get from both systems is the same, I'm not going to have to include income in my analysis. Let's see. Oh, here it says here, right? So both systems are expected to have about the same functional value and useful life. A one-time tax credit is available for the second one due to federal government encouragement of this new technology. Okay, so the second one we're going to add in an income, just $15,000, but otherwise we can leave income out because they have the same functional value. So we don't need to put it in, right? Because basically we're going to compare them to, and that's not something that's going to vary between them. All right. And then you have information here about opportunity cost. So what I'm going to do is I'm going to evaluate the first one, and then we'll go to the second one. Okay, so we'll evaluate the first one, and then we'll go to the second option. So you get two exercises we'll work on. Okay, so keep this all these details of the case aside. What I'll do, I will extract it. Do that again. Okay, so here we have details. Details of the case. So we're going to do this in 3 parts like I taught you. Another way to do this is, I mentioned to make a table with all the information. The other way is, the way I have it on some old tests, or probably, but for the final exam, I'll ask you for the components one by one. It's easier to grade that way for the grader. I don't know that I'm going to use the grader this time. I might do this myself. We'll see. So what we want is present value of income, incremental, right? This is all going to be incremental. So what goes into income? Just the expense piece. So it says a cost of $3,000 per month. One second. So it's just going to be the incremental cost. $3,000 per month as an annuity. It's a cost, so it's going to be negative. So it's going to be negative cash flow, right? So negative 3,000. And the payments, notice this is monthly. So what do we need for monthly? Step 1, always. You need the monthly rate. I'm going to do the calculations below. So we need the monthly rate. So you see how everything comes together now. We have to use all our tools. We have to be able to use all of our tools. Now the rate for this problem, the rate given is 12% cost of capital. So this is the opportunity cost. That's what we're going to use as our discount rate, or our I in the formula. So the EAR is currently 12%, but we need, let me put that lower. You're given EAR of 12%. So what is the relationship? 1 plus EAR is equal to 1 plus EPR, 1 over 12. Now, at this point, you could be memorizing these formulas or using the formulas, but I like to go back to the understanding that 12 months makes a year, and then I remember what I need to do. So I need to take 1.12 and chop it up into 12 bits. Take off the principal to get the monthly rate. So that is the monthly rate. And put it in storage. Okay, so do that. And and what we want is, so the PV of income is equal to negative 3,000, and we'll use that monthly rate in the annuity formula for how many months? It's a 5-year project times 12, 60 months. So that is what I write for income. I don't have to use the table. If you like, you guys can do the table. Why should I do a table for that? That's all I have to put in it. Am I missing something? What am I missing? Che falta? Okay, I'll put the discount, so while you're thinking about that. Be careful of the instructions for the test where I tell you how many decimals to report, okay? Because a lot of students, most of you, did not use the right decimals. And I took off marks. Half mark. Oh, construction. Very nice. They're always building. I just wish I knew when they would do it. All right, so what am I missing? Now nobody knows. If you go back to net operating cash flows, this is what this is, right? This is supposed to be, this is all I have for net operating cash flows because everything else is going to be the same between the two alternatives. So this is an expense. So before you go to the next component, always ask yourself, have I dealt with taxes? Taxes are missing here, right? Expenses are tax deductible, so that reduces the actual expense. So I need to put that in. So I'll do that here. I'll leave some space. Was it 4%, 40%? Let's see what it was. 40%. Okay, so that's our expenses will be lowered because it's tax deductible. There you go. So that's what you would write on your test or on an assignment. You can simplify this amount before you put it in the calculator. I'm going to go back to talking about the interest rate in a second for people who are struggling still with the interest rate calculation. So this is just 1,800 that you're going to put in. So you could also write this as 3,000 just times 0.6, right? After tax. Okay, so let's see about the interest rate. So for the interest rate, 1.12 to the power, you say 12, and then you flip 12, and you get your answer, -1. That's how I would deal with that in this calculator, okay? Let's do it again. 1.12 to the power 12, but you flip 12, so it's an exponent fraction 1 over 12, and then you get your answer, -1. Now we have that value, we times by 100 to make it the interest rate. We have 60 months, and our payments are 1,800. We put 0 in here and we ask for the present value, and that's what I get. All right? Questions? Okay, so I'm going to put that number over here. So that's the answer for income. And I'll circle my answer because this can get very messy. Now this you can round to 2 decimal places because you have to add it to other things later. So let's put this one in storage and I'll just override what I had in storage 1. So that's the first part, that's income. Ready for the next part? No, I want this one. Let's take this again. Kind of need a tutor in this. I'm surprised by some of the things that the iPad app does. So this is the cost. Are you asking for interpretation, Paola? Well, this is the cost. This is the cost of running the project. This is the incremental cost. It's like present value of incremental income, and it's a cost. Because it's a negative. It's a loss. Okay. Next part. So we've dealt with expense and income. Now we go to investments. So investment involves this, capital spending, net working capital, and salvage. Okay, so we're going to do this with we're going to spend a lot of time here. So first, we'll make a point that the initial cost or the initial investment it doesn't have to be the present value because it is, but okay, let's write down to present value investment. So first is the initial cost. The initial cost is minus 140,000. Then because of this purchase, this generates depreciation, right? So let's make the table for depreciation. And now, again, you can do this on Excel here. And actually, that's what I'll do. I'll do that in Excel. And remember, D is calculated as 140 times the depreciation rate. And then the undepreciated cost of capital goes here. And then the tax shields, which we'll deal with in the third part. It's a 5-year project. So the numbers we use are in the 7-year depreciation schedule. So you're going to go to the maker's table for that. Let's get it out. I think it's here. So we need these values. Oh, I can steal them, right? I can take them. Let's take them away. I think I can. Copy. And then take it over here. Put them here. Yes. Oh, look at the beauty. There are some advantages. Definitely to teaching online. Okay, so those values will go in this column here. 0.143 and 0.245, 0.175, 0.089, and then 0.089. So it returns to straight line depreciation after that. Okay, so that's all I need. I don't need the rest of the table. Did I do it right? Oh, no. I missed one. See? I can make mistakes. That's really bad. That would be really messy and wrong. 0.125 and then 0.089. And so all I have to do, the way this is set up and these were computed, all I have to do is take this column value and multiply by the initial investment to generate all the depreciation amounts. So I can do that in Excel. Just debating whether I want to do that. Okay, let's see. It doesn't matter where I do it. Okay, so then so I could put year. Oh, it just bothers me that it's not centered. This is why I don't like to use Excel, because I get obsessive. Okay, year. 1, 2, 3, 4, 5. And then little d. Caps are on. That's the thing, drives me crazy. How do I get a small d? iPad is different. Dear. Why can't I get a small d? I'll put a space and then d. Why won't let me? Wasting time, right? Why are caps lock automatically on? Something's wrong with my tablet. Let's see. If I... There we go. So those are the columns. And we copy these numbers, 0.143, 0.245, 0.175, 0.125, and 0.09. And then you want to do, all you have to do is multiply 140,000 times this amount. And you repeat it all the way down. That did not work. Oh, there's Phil. I don't know. This is why I didn't want to use Excel, because it's a little bit different than I'm used to. I'm just going to copy. Those are the amounts. And then this amount is your book value. We'll talk about the tax shields in a bit. Okay, so those numbers would go in the table. Well, maybe I can, no, I'm trying to think how I can take it over. Maybe I can't take it over. Let's see what happens. It worked. So this would be my table. I can erase this messy one. Okay, so what we see here is, well, maybe I should make them, I'll format them so they're dollars. I honestly do not know what I'm doing in this software. It's a little bit different. Where's my format? Data, format, view, no. Format cells. All right, I'm just leaving it. Don't worry about it. And it looks like the book value here is less than the sale value that we anticipate. So what happens? We're selling it for more than it's worth, and we have to pay taxes on that. There's capital gains, right? So that's going to go into our consideration. And what else? So we have all the amounts here. Oh, I'm missing the column of UCC, aren't I? So I got to put that in. So let's fix that up. Let's go back and do, I have to put the undepreciated cost. That's not the book value, you guys. I'm so distracted. That's not the book value. This is UCC. Let's do this again. UCC. And that's not the book value. I'll fix that. Sorry for confusion. This is what I have to do. So I have to take the original value and subtract the depreciated amount. And that leaves 119,000. So what I do with that is then in the following year, I use that amount and subtract off the new wear and tear, and that leaves 85,000. And then I do that again and subtract off the new wear and tear, and I do that again all the way down. There you go. Now I did it right. Oops, what's that? What's happening? It's starting some function. This is why I didn't want to work here, because there's surprises. So all I want to do is minus this amount. That's all I want to do. Oh, it's triggering something. I don't know why. That is the book value. There you go. Now, one last column is the 0.4 times D to get the tax shields, tax savings. Or tax shield in each year. And that's just 0.4 times the D, like the total depreciation. So that's equal to 0.4 times D all the way down. Oh, I can't do it. All right. So now I can take this table and bring it over. Let's get rid of this one. Good. And you can ignore this column. I can't erase it. There. All right. How's that? There you go. So this is now what I'm interested in. So this amount is more than the sale price. So actually, we're selling it, the market value is less than the book value. So we actually can report a loss and make tax savings for it. We incur tax savings for that. Okay, so let's erase this one. And you could put this all on a table, but I'm going to do this in steps. Any questions about this table and how I got these values? So all of these were oh my goodness. These were computed as D times 140,000. These are all thousands of dollars. UCC is, I hope that's self-explanatory, and so is that, I'm hoping. Let me know. So what I'm going to deal with before, well, for this component, so investment is the initial cost. Oh, I erased it. So the initial cost negative 140,000. Then the sale or salvage and we want the present value of that. So we're going to do this where the present value of the salvage is calculated as the sale value minus the tax treatment, the fact that it's worth and this expression I have in the notes, right? The tax savings, because it's worth 31,220, and the market value, however, the market value is 20,000. And this amount means we're going to be adding the tax savings, and then we need to discount this by 5 years because this is going to happen in the 5th year. Right? So we needed the table to get the book value to do this. So what else goes into investment? Okay, so the purchase, the sale, and then net working capital. Net working capital, I'm going to go through how we get the net working capital investment cash flows. Oh, we have to calculate this amount, right? So we should get this amount before we continue. So if you put this all together, this is equal to $13,895. So this is positive $13,895, 15 cents. Now you can leave it there. You can store it since you have it on your calculator. Make it store too. For the investment cash flows, the story is that You need an inventory of $15,000. And you need it at the beginning of each period. So that means the net working capital required is consistently $15,000 worth. That's immediately 1, 2, 3, 4. We need one more. These are the years. Oh, I'm not going to bother. Okay, so $15,000 across the board. So what changes? I need to have $15,000 of inventory set aside. Immediately. So there's an investment of $15,000. That's the value of it. And then I just need to keep the $15,000 in inventory. But so there's no difference over these years, right? I just got to keep $15,000. If I use it up, I have to replenish it. Always has to be $15,000 worth of inventory. And in the end, we don't need it any longer. So by the end of year 5, the inventory returns to the firm. But in terms of investment, so that the way I've written up this table so far is treating, hold on. I'm treating hold on. I'm treating this as I'm looking at this from the perspective of the project, but from the perspective of the firm, in terms of cash flows, this is an investment. So essentially, and this returns to the firm. So from the firm perspective, those are the investment cash flows. And those are the amounts that I need to discount. Okay, questions? All right, so what's left? We have salvage, we have the net working capital. So let's get the present value of the net working capital investment. Which is just the 15,000 invested up front and then the amount of the 15,000 returned or recovered by the firm. Line out. Oh my goodness, what a mess. Everything's not moving at the same time. Okay, can you see that? I'll leave it for that. I apologize if this makes you dizzy. I think you can see it just fine. Right. So let's make the calculation for that. What do you get? $6,488.60. And this I will store in 3. And then you put all the amounts together. So you put the amounts together, the present value of investment is equal to the initial cost plus the present value of salvage initial cost plus and and then plus the present value of net working capital investment. So this is negative 140,000. This amount was $13,895.15, and this amount
was 6,488.60. Okay. So when you put it all together, you can recall 1. That's not a recall, you just type that in. So you take that amount plus recall 2 minus recall 3. If you've stored them and you get a negative result, this is your investment of $132,593.45. Paula, thank you for writing. Double check what you got. So yeah, use storage to not, to save time. Store the values. Do we add the present value net working capital investment? We add it, but it's a negative. We add it, but it was a negative. Wasn't it a negative? This is a negative, sorry. We have one more part, one more piece, and we're just finished the first, just the first option. So the last piece is the present value of the tax shields. And the tax shields are from this table. I'll pull them over, I'll copy them. Just the table, please. So the tax shields we get from this column. Let me just say where this number, store this in for. So for the tax shields, what you have to do is discount. Notice that we discount for the end of year 1, right? There's no tax shields in year 0. So the present value of tax shield is 8008 over 1.12 plus 13720 over 1.12 square plus 9800 over 1.12 cubed plus 7000 over 1.124 plus 4984 1.125. So those can go into your NPV keys, right? And you should get $32 million. No, 32,000. 32,339.63. And I can round to 2 decimal places for each part. Otherwise it gets very tedious. If you did it round and you leave the numbers in because you store them, that's okay too. That'll be okay. So to put those together, this is part 3. So finally, the answer is NPV option 1. It's equal to the sum of the 3 parts. What are the 3 parts? Let me go back. So this was part 2, right? And part 1 this thing is driving me crazy. I can get rid of this. Oh, there. Okay. In part 1, I want to get it from here. I was on the first page, wasn't it? It was just the expenses. Up here, okay. So that was part 1, remember? Okay, so oh dear. So we had part 1, which was present value of income. Part 2, which was present value of investment, and part 3, which was the present value of tax shields. So you put those together. This is a negative. This one's a negative. And this is a positive. It gives you this value. That's a negative. So option one, this is the present value of option one, the net present value. It's a negative. Do we reject this project? No, we have to compare it to the second one, all right? So we're going to just compare the NPVs of the project because we've completely ignored income that would have made this positive because we're assuming the income for both options is the same. So this was option one. So now you have to do the exercise for option two. So don't lose hope. I mean, it's just repeating the same thing. It's not a big deal. It's just time, okay? It takes time. Okay, everybody okay on option one so far? Income, investment, that was the salvage, so the initial cost, the salvage, and the net working capital investment. And the part three would be tax shields. Now we go to option two. And I'm going to give you a couple minutes to read through option two. Let me give you 5 minutes. Okay, I'm going to get some water.
Okay, I'm back. How'd you do? Oh dear, I moved down. Let's see. Okay, so let's look at option 2. Let's look at option 2. Oops, where's option 2? Option 2, below. Alternatively, NTL can invest in a network system with smart terminals in which all computing will be centralized using internet connections. The system is available through a central provider at an ongoing annual fee of $55,000 per year. So this amount is also income, goes into income. As an expense. This system is available through, okay, the hardware requirement would only be, the hardware requirement would be only $45,000, but local maintenance would be $6,000 per year. Okay, so this is equipment that's purchased. So this would be capital, correct? So this part is capital or goes under investment. And the local maintenance per year would be $6,000, so this also goes to expense. No increase in inventory supplies would be needed, but additional external consulting fee of $8,000 in the year in which it was incurred for each of the first 3 years due to the use of a new technology. So this will also be expense. The local terminals required would have a value of about $5,000 in 5 years. So this is salvage. Again, this is a 5-year project. And they would be sold at the time to a competitor. Networking capital requirements are here, related to working capital requirements immediately and then to the end. You know what? I'm just looking at what I did here because I might have done my networking capital wrong here. Oh, I did it wrong here, didn't I? Just to point out here, sorry not to backtrack, but I had to. Correction that this should be a 0 and then my numbers work. Man, you have to watch my entire video, don't you, to make sure I don't make mistakes. Well, that's okay. You guys should watch it anyways. So that should be 0 in the 5th year for option 1. So that this number is negative. Anyway, everything's right. It's just that one should have been 0. We don't need anything by the end of year 5. And it should always be like that. So if your project extends beyond the 5th, if you do not recover or return these amounts to the firm beyond the duration of the project, you'd have to have extra columns in here. That might happen. Okay, so here you have the 0. It should always be 0 unless there's extenuating circumstances. Okay, both systems are expected to have about the same functional life and blah, blah, blah. Okay, so I read all that already. Okay, so that all these go into expenses. There's the salvage. This is the capital spending. So just like last time, I'll pull this with me over. Last two. So part 1 is the present value of income, which ends up being just the present value of incremental cost. So it's going to be the 55,000 and the 6,000 each year. And you can expense that. And that's an annuity. So that's going to be tax deductible every year for 5 years. In the first 3 years, though, there's going to be that consulting fee of $8,000, which is also tax deductible as an annuity. For 3 years. And when you put that all together, in the interest of time, I'll just give you the result. Okay, so that ends up being 143. 463 60, and that's a negative. Okay, so like before, we don't account for income, just the expenses, because the income is assumed to be the same for both projects. So that's income, negative 143,000. All right, investment. We have the purchase, and then the purchase of the hardware, and then we have the salvage value. We also have, because of the investment, there was a government subsidy, right? They sold you below here. Oh, let me erase this. There's a government subsidy here. So that will go into the investment as well. Because you get a credit of $15,000. So we're going to include that. I'll make some room. So the initial cost was the $45,000, but then we have the credit one time. So this initial cost is $30,000. All right, so now let's go into the let's make that table for $45,000 with depreciation. Oh, what was it? We're going to use the same 7 year, right? Yeah, we'll use the same 7 years. So now it was, the initial investment was $45,000. So how does our table change? These stay the same. I'm going to change this to, okay, let me clear this up because it's going to be confusing, isn't it? Let me delete. Okay, so I'm going to put here, remember this is the formula of 45,000 times depreciation. And I do that all the way down. Oops. Oh, I hate when that happens. How do I go back? Okay, so those are the amounts. Any questions about that? So that was 45,000 times the little d, all the way down. Then I need the undepreciated amount, so that's going to be the 45,000 minus what was depreciated. And then I'm going to take what remains, undepreciated cost of capital, minus the following year, and I'm going to do that all the way down. And this is the book value, right? Now we're told we can sell this for $5,000 at the end of 5 years. So that's not enough, right? That's where there's going to be a loss to report. So we have tax savings as a result. So we'll make that computation. Let's just do the tax shields so I can bring this whole table over. So the tax shields are the tax rate times the claimed amount all the way down. And then I can copy all of this. And put it here. Now what I'm going to do is get that, do the salvage calculation. Present value of salvage is equal to the 5,000 plus the tax treatment of the book value minus the 5,000 and I'll just put it in here that this is 0.4. And then everything discounted because that all happens in the 5th year. And this calculation gives, sorry it's so messy because I have my iPad up right now. I should probably just put it down. I don't know. It's not so neat. I'll try and write slower. So that's the amount. And it's a positive from selling the hardware afterwards. So we have that's the initial cost, that's the salvage, and what else? For investment, net working capital. Correct? So let's do the net working capital. And you've been given a table. I'll just copy the table over. Actually, I should probably do this in Excel too. So this is the net working capital required for the project. Current assets minus current liabilities. It's all been put together already for you. So this is net working capital required. And what we need are the net working capital changes because we want this to be incremental in each year. So immediately we need 4 million. And then an additional 1 million. And another 1 million. And then we don't need as much, so we release 3 million. So how am I doing this? I'm calculating this amount minus this amount to get this. This amount minus this amount to get this, and then so on. And then we recover And finally, the project is over. So the firm recovers 1 million. Finally, we really want to know about the investment cash flows. The investment cash flows, from the perspective of the firm has to invest in this project. So these are actually, in terms of cash flows, these are negatives here, all the way until well, this becomes a positive. So basically this last row is to change the signs, is what you're essentially doing. So those reflect the investment cash flows, and they go into the NPV keys of your calculator. I would write present value net working capital investment is equal to, in the first year immediately, this amount, and then you discount the other amounts. And when you put all that together, you get the value I'm over time. I'm just going to finish this. If you have to go, get going. I'll just wrap this up and you guys can have it to look at later. So this is the amount for net working capital investment cash flows. All right, so I have the investment, initial cost of the investment, then the salvage, which is a positive, and now the net working capital investment, which is a negative. I can put them all together. So I'm going to put them all together. Those three components, and get the present value of investment as part 2. I'll send you this. I'll send you the answer key for this, so it's much neater. The present value of the investment then is a sum of all three of those. And you get a negative because it's an investment of 1,742,267.07. And I'll also send you the clave for the one I didn't do. I didn't even get to do the other exercise I was planning to do. And finally, the tax shields. When you take the present value of these tax shields here, Oh, so frustrating that it separates everything. Don't know why that happened. So let me just say the present value of the investment, I already wrote it, but it's gone. I moved it. It's here. Oh, what a mess. I'll just leave it like that. Okay, so then for the investment tax shields, you need to discount these amounts and get part 3. And when you do that, you get 10,394 and 88. So what's happening is you are buying a $45,000 piece of hardware, you get a tax credit for it, and you get to this in terms of the effect in present value terms of claiming depreciation on it. So you get almost half the money back, okay, in time zero value. So when you put all this together, option 2 works out to be so you're going to put 1, 2, and 3 together. I'm gonna pull up my solutions. Much nicer looking. This is so messy. Oh, I don't even have it here. Let me put it here. So this is what I'm gonna send you. Okay. So this is the problem. This is everything we did. And the result is putting 1, 2, and 3 together, you get this amount here. And you have to compare this amount, 1,875, like 1,875, to the other one that you got, which was 182,000. So comparing 182,000 expense, really, it's a negative cash flow, with 187, this is your cost. Option 1 is less costly, so you would pick option 1 to option 2. Okay, so you pick option. So this is the I wanted to finish it because this one's a little bit different, right? Because usually I ask you just to get the NPV of the project, but here I'm asking you to compare 2 projects and the NPVs are negative, so it might be confusing, but don't be confused. It's just saying which one is more which has a higher NPV? Really? The one with the higher NPV is the less negative one, so that's option 1. All right. So I will send you the solution, and I will also send the solution for 3.7. And you guys can email me if you have any questions. I can meet with you. That's no problem, okay? Okay, let me know if you have any questions. I'll stay on for a few minutes. I don't know why that shook. Okay, so we'll talk to you. I'll be in touch at 6. I'll send you the test, and then you can ask me questions. Okay, if you need clarifications on things. You have all the materials to work with, and as before, you have the right to use all your resources, but you cannot use the help of another human being. Okay? Unless you have a question of clarification from me. Good luck. You can also watch my videos if they help. You have lots of time. Well, I think you have a lot of time. Yes, all the material I've given you, Diego. So get to it. Let me know if you have any questions. And as I explained there, it's tedious, it's long. I don't know if tedious is the right word, but they're long exercises, but they're not hard. Okay, they're not hard. They're just long, and you have to endure. So don't exhaust yourself. Make sure you have a good sleep tonight. Make sure you have a good meal. Get some sun. If you want to read the book, I think I already, I have to look in the prontuario because I mentioned it before. The chapters. This is everything capital budgeting. So this would be really, we've done, it's everything. It's 2, 3, 4, 5, 6, 2 through 6. So next week I'm going to start with chapters. Well, next week we don't have a class, but right? Because it's Easter. When we come back from break, we're going to start with chapter 7 and 8. So we have 2 more months. We have time to do this. Yes, Miguel, the exam is tomorrow, the test. I'm going to send the exam tonight at 6 and it's due. Due tomorrow at 3. And the focus would be, the modules, so all the notes with 2, 3, or 4 on them. I explained at the beginning of the class that some students had have things they have to do tomorrow that are not exactly important to me, but because of the uncertainty of the situation we're in, something came up for tomorrow. So I'm sending it today at 6 if you want to start early, because they're getting it at 6, okay? But really the test should take you only an hour and a half. If you know what you're doing. You can text me if you have questions, email me. Okay, I'm gonna sign off because I need to eat something before a meeting. Okay, so bye for now.